Hello, I'm Steve McClellan, your friendly financial engineer, where we show you how to grow, control, and keep what you build instead of giving away to taxes, fees, losses, and the unknown. And that's exactly what we're going to do here today. We're going to show you a way not only to create wealth, but to keep it as well using a properly structured dividend paying whole life policy. Now, before you run to the hills and think that this is going to be boring as watching paint dry, I will do my best to keep it entertaining, short, and I'm actually going to use my very own policy to show you how effective this can be. This is a game changer, folks. It's a game changer. It was a game changer for my business. It's a game changer for my clients, and it's going to be a game changer for you. Now, several years ago, I was on my way out of the financial industry. I was getting fed up and tired of all the nonsense, the noise, and pushing products that simply don't work. Luckily, another trusted independent financial professional gave me this book, Becoming Your Own Banker by Nelson Nash. I read it. The engineering in me dove deep, went through the numbers to see if it actually worked. And now I'm passing on my knowledge to you. I can sleep at night. My clients can sleep at night. You can sleep at night, no matter what happens to the economy or to the market. And let me show you how this works. So I'm going to use my very own policy. Let me remove my handsome face here. You go into the corner. Yeah, get up there. There you go, by in the corner. When it comes to whole life, I would say roughly 10% of the financial professionals out there even talk about whole life policies. And then 10% of the 10% design them in a way that you can use them while you're living. Very, very efficient. So what this is designed here is very cash heavy and insurance light. So let me show you what I mean. When you're designing a whole life policy, there's two components. There's the insurance component, and then there's the portion that you can use while you're living. I have for my insurance 100,000 whole life policy at an annual premium of $1,979. That is going to be paid to the age of 91. I can pay that outright, or I can actually have my policy set up that the policy pays that premium. And I'll show you how I do that pretty soon. I also added a 10-year, $1 million term rider at a premium of $841.92 for the next 10 years. And if you're looking at these numbers, a lot of people will ask me, they'll say, Steve, why am I paying almost double for 100,000 of insurance versus the 1 million? And would you, if you were to take any guesses, would you know the answer? Well, let me share the answer with you. It's simply, this is for 10 years. The insurance company is pretty confident that I'm not going to die in the next 10 years, but let me be the bearer of bad news that we are all going to die someday. We're all going to pass on no matter what happens, as long as I'm not committing an illegal activity. No matter when I die, my family will get at least $100,000. This term rider, it adds the amount of insurance for the next 10 years, but look what it also does. It allows you to put in $44,197 or $95 into the portion that you can use while you're living. This is the portion that gets the dividend, that grows tax efficiently and gets compounded growth, and it's vested. I love the fact that this is vested. That means it never goes down, regardless of what happens to the economy or to the market. What do all these numbers mean? Okay, there's lots of numbers here, folks. They're fuzzy. I do apologize. I need to put on my glasses. What this means, you need to put the minimum amount to cover the cost of insurance. The first 10 years, that's $2,800 and 2821. And then that 1 million, 10-year term rider is dropped. So for the rest of this policy, from here to 91, no surprises. It's the same. It doesn't go up. $1,979. Easy peasy. As you can see, if you put the minimum in, you still get a cash value. It's not much, and you get the death benefit. So, okay, not exciting. But look what happens if you put the maximum in. And this is also a very flexible policy. This is the maximum. This 47,000 is not what you need to put in. This is the maximum that you can put in. This is the minimum to cover the cost of insurance. So after year one, you put in the maximum, you have access to a cash value of $43,381 and a death benefit of $1.259 million. Now, when I first look at this and I see you're telling me if I put 47,000 in, I only have access to 43.3, this doesn't seem like a great deal. Well, the first couple of years, it's not a great deal. Why do you think this is lower than what you actually put in? What's coming out of here, folks, is the cost of insurance, the cost of underwriting, and commissions. But you can see it breaks even at year 4. And look down here after it's getting that tax efficient, true compound growth vested, never goes down at that magical age of 65, where everybody feels like they have to retire. You have 1.65 million and a death benefit of 3.3. Now you have several ways to get access to this 1.65 million. The top 3, you can take it out directly, and I don't recommend that because you'd be taxed like a traditional investment. You can use the insurance and do what's called a policy loan. And this is a simple autograph. What's nice about this is if times are tough or life happens to you, all you need is an autograph. You have access to your money through a policy loan. I don't know if you've ever gone to a bank when cash is a little tight. They're not really your best friend, are they? Maybe their best friend when money's flowing in, but when life happens, they're no help whatsoever. But if you want to do a little extra work, you can use a bank loan to get access to your cash as well. Before I turn this off and see what happens down the road, I just want to show you what would happen if this was an RSP. So say you had that 1.6 million in RSP and you needed it. Who knows what you need it for? Anything, could be for anything. You need that 1.6 million. How much would you actually have access to? Well, if you live in my province, unfortunately, the government's going to take roughly 51%. You get to keep 49. So roughly 800,000 of this goes to the government. 800,000 goes to you if it was an RRSP. But this is not an RRSP. This is a properly structured dividend paying whole life policy where it's your money. You have control of it. Boom. And if you live that long, prosperous life, you have a cash value of 3.8 million bucks. Death benefits the same. Talk about leaving a legacy. And I'll chat about that pretty soon. Okay. So let's compare what the other advisors, the other financial professionals are doing out there. Now, this policy that I'm showing you right now, this is still a strong policy. This is a good policy. What I showed you is great. It's max efficiency. This is still a strong policy. Using the same premium of $47,015 as I did for the other one, you'll see the cost of insurance is $12,346, giving you a deposit option of $34,669. So here's a ton of numbers, but let's compare these side by side. So the more efficient policy, the break-even point is year 4. Here, the break-even point is year 9. If you take the age of 65, you have a cash value of 1.65 million bucks. That's what you have access to while you're living. Oh, getting ahead of myself. Here, you have access to 1.47 and a death benefit of 2.8. So this is a more efficient one. Where this policy, this insurance heavy policy kicks butt is look at the death benefit of age 100, 6.5 million bucks. That's huge. So if you're more concerned about leaving a legacy, you feel like you're going to live that long, prosperous life, maybe this is a policy for you. What I love is being independent. We can do what's most important to you. We're not tied to an institution. Again, I just want to hit home why I like this policy more is the annual premium for this insurance heavy policy is $12,346. This is the minimum that you got to put in. If life does happen, this might be a stretch. But the 2,800 followed by the 1979, that should never be difficult to do. And once you have a little cash value in there, you can use the cash value to pay for that policy. Pretty powerful stuff. I want to be clear that this is a portion, one way to create wealth. This is part of your diversified portfolio. Now, if you're talking to most financial professionals out there and you're talking about diversification, they're usually going to talk about a balanced fund. That is not being diversified, folks. No, a truly diversified portfolio consists of your business, your source of employment. Real estate is a great way to create wealth. Investing and saving, that's what gets all the news. It's very easy. It's very emotional. It's very fun. It's also very scary and stressful. There's the living benefits, business owners, if anything were to happen to you, just to keep cash coming in while you get better. I'm the expert when it comes to whole life and helping you become your own bank. And of course, there's the alternatives such as crypto, angel investing. As my dad used to say, there's more than one way to peel a potato. Looking at this, folks, if I was to ask you, where are you going to create most of your wealth? What would you answer? Now, I truly hope you know the answer and you're going to say, it's my business. It's my source of employment. And that is so true. When you realize that you are your number one asset, you need to start acting like it. What I love about the whole life policy, it complements all these other sources of wealth creation, but it's the only one that is not affected by the economy. It's not affected by the market. It continues to go up, growing tax efficiently. We all have a destination that we want to get to. The number one way that's promoted in the current financial industry is to invest. And as you can see, it's very up and down. It's very emotional, but there is truth to that long term of buy and hold. The market does tend to go up. But when do you think most people buy? And when do you think most people sell? There's another way to get where you want to go. And this is what a properly structured dividend paying whole life policy looks like. Kind of boring at first, but very exciting as you continue your journey. And what's nice about this, you can use your policy to buy the stuff that you want and still capture that compound growth. We're using it to help fund the building of our backyard. You can see we're putting a pool and a turf. We're using our whole life policy to help fund this and still have that money grow for us, so we have it in the future. I love this picture. I think this captures what a properly structured whole life policy looks like and what it can do for you. Look at that growth. That is a beautiful thing. If you want to learn more, all you have to do is reach out. Go to our website, Design an Even Better Future, set up an appointment with us, and we will sit down and help you to design that better future where you can grow, control, and keep your hard-earned money instead of giving away to taxes, fees, losses, and the unknown. We look forward to chatting with you. Until then, be healthy, be wealthy, be wise, push through the noise, and all the best.